Hello everyone, today we're going to be talking about Mercado Libre, the excellent e-commerce and fintech company that is a dominant and fast growing company based out of Latin America. With over 50% revenue growth and experiencing explosive free cash flow growth, there is a lot to get excited about with this company. So today we're going to be talking about their business and their competitive advantages. We'll take a look at their financials, focusing specifically on free cash flow, and finally we'll discuss their valuation. We'll see whether they're a buy right now or maybe whether we should hold on a bit before adding them to the portfolio, and whether it looks like a buy given historical metrics and DCF models that we can run. So there's lots to get into today, but if you get something out of this video, then please feel free to give it a like and maybe subscribe to the channel so you don't miss out on anything. For those that are not aware, this e-commerce giant share price has soared over the past 5 years, up 164% in that time frame, and currently sits at a share price hovering around the $1,700 mark. This has outperformed the S&P 500 in the same time frame by a considerable margin. Now, Mercado Libre is an excellent company that operates out of over 18 countries. Their strongest markets come from Brazil, Mexico, Argentina and Colombia. Now, Mercado Libre is a leading e-commerce platform is the best way to describe them. Now, they're based out of Latin America, receiving over 668 million visits per month, which beats out Amazon in both Brazil and Mexico, with Brazil making up the largest proportion of their revenues, followed by Mexico and then Argentina, with both Brazil and Mexico growing those revenue streams at over 50% from fintech and e-commerce. They're mainly focused in these three countries, I would say, given the number of sales that they have in these regions. They don't actually sell any products themselves, but they do give sellers a rating based off various factors such as successful sales and customer satisfaction. This online marketplace that they operate may be the largest aspect of the business, but it's not the fastest growing. That would be Mercado Pago, which is their fintech business that they run separately. Now, this has broke into the fintech space quite impressively and grown rapidly, undercutting the main banks in Brazil and Mexico. They're increasing in all areas from monthly fintech active users quarter by quarter to 49 million in Q1 2024. All the way to their credit portfolio, which is increasing 46%, particularly on credit card portfolio aspects, seeing 132% year-over-year growth. Now, that's despite poorer growth in Argentina, specifically for Mercado Pago, because of the devaluation of the local currency there, the peso. So they have used their customer service base through the online marketplace to create a fast-growing secondary business, their fintech business, Mercado Pago. Alongside this, they've seen success in their MELI Plus loyalty program, which is similar to Prime, but in a lot earlier stages of growth. They're seeing people on MELI Plus actually spend more money per visit and visit for longer on the MELI site. So that's good to see. As another source of revenue alongside all these things, they've also got advertisement, which has been growing quite impressively with 64% year-over-year growth in Q1 2024, back from 2023. One of the things this company's got going for it is that it operates in poorer regions of the world. So essentially having a reliable fintech company that's on hand with a brand that's recognised and trusted by lots of people and used all over the world is going to give very good potential for growth in the future, in my opinion. But when we look at the financials of the company, they are still exceedingly impressive despite the drawbacks of Argentina. They're experiencing steady and explosive growth in revenue, growing 42% in the past 10 years and 58% in the last 5 years to $15.8 billion. Outperforming Amazon in just sheer revenue growth alone. Their net income has been decidedly more up and down, but seen in the past 4 years to become highly profitable, growing from negative to $1.1 billion at this time. Their cash position is accelerating each year as well to $2.6 billion compared to a long-term debt position of $2.2 billion, which is also increasing but could be paid off straight away by this company without years of revenue needed. Finally, its free cash flow growth is just the highest amongst my companies in my portfolio, with a 77% year-over-year growth CAGR for the past 5 years to $5.2 billion, which is just amazing. Now, there are a few risks associated with this monopolistic e-commerce giant. Chief among them is that where they're located. This company operates in the poor regions that we've mentioned previously, which offers some advantages but offers very obvious disadvantages. So e-commerce and economics could be shrinking in these areas and doing very poorly. This may be true in Argentina, where Mercado Libre has suffered and faced headwinds, specifically in the e-commerce side of the business, with demand and earnings falling due to the devaluation of the local peso. That being said, their fintech side of the business has seen massive growth in Argentina, with active users growing about 31% year over year in Q1 2024, despite the headwinds in their profit margins due to the currency devaluation. Another risk, I would say, is the size and scale of their operation. Now, this is similar in vein to Amazon. They have swings in profitability and free cash flow. This means that if the company overinvests in itself, its free cash flows may suffer, or if it faces inflated costs due to the running of their day-to-day operations, this could impact their margins and therefore their profit. So in summary, Mercado Libre is a very successful e-commerce and marketplace platform that is building other sources of revenue stream in the form of the fintech space and of course the advertisement space on their platform. They're massively profitable in both Brazil and Mexico, which is their main proportion of sales, but they have hit headwinds in Argentina, specifically due to the local economy and the devaluation of the local currency. But that being said, their fintech business is growing very well. This is highly margined and obviously is massive revenue stream for the company now. So I'd like to see that continue to grow, build monthly active users and generally become more profitable for this company going forward. We've also noted that the company operates in poorer regions of the world, which carries risks that we're similar to what we're seeing with Argentina. So they operate also in a high operating margin and cost business model. So effectively, this complicates things with terms of day-to-day running of operations, inflated costs in terms of shipping and stuff like that, which Amazon has struggled with in the past and MELI could face in the future. So that could cause problems in the future. So there is a few risks. Now, in terms of the current share price, what are we seeing? Is it overvalued or undervalued? It's currently trading for just close to that $1,700 per share mark, which is up over 55% for the year, which has also beat out the S&P 500 in terms of performance by nearly double. So should we be waiting for this stock to come down or buying now? To give us a better indication, if we take a look at the free cash flow yield that this company offers at its current share price, we can see it's been getting better and better in the past 4 years. So whilst the share price has increased, it's been outpaced by the free cash flow growth this company is seeing. With the yield sitting at just over 6% now, that's above the rate of return that we might see with the 10-year Treasury bonds at 4.3%, which is a risk-free investment that we could invest in rather than this company, which offers us a margin of safety for this company. It sits well above the average for the past 4 years for this yield and in general is not far off that high yield that was offered back in April in 7.3%. So this lines up with other metrics like price to free cash flow, which sits at over 16, well above the average for this company in the past 4 years. So that signals undervaluation, but we can't take it in isolation. It's just an historical metric to give us an indication. Moving along to our discounted free cash flow model, just to see how quickly that growth and free cash flow is growing compared to the value of the company and how much the share price is. If we add up all the cash flows in the past 10 years, that gives us an average growth rate that's just massive because of the more recent years in the past 2 years becoming highly profitable. But if we say the free cash flow will grow just from 2023 around the 8% mark, which I think is very low considering in their Q1 2024 it's grown to $5.2 billion, which is higher than we've already reported for 2024 in total. But if we take that number anyway, because it may come down, and then we apply that to the DCF price and their shares, we get a share price that sits around $2,332 per share, which would give us a margin of safety over that 25%. Additionally, this lines up with Wall Street estimates for this stock with an average forecast around $2,030 per share, 19% upside, and a high forecast of $2,383 per share at 39% upside. So if you ask me, there is signs of undervaluation with this company. That's from examining historical metrics like their free cash flow and from looking at DCF valuations on their free cash flow, with a caveat of Wall Street analysts predicting very similar, although if you ask me, they are susceptible to manipulation because they want to keep their jobs. So that being said, that is with a caveat which comes from their growth. If this company refuses to grow in the same way in the future, then this valuation may be less desirable. They haven't seen years upon years of free cash flow growth. We've only seen that rapid profitability in the past 2 years. So it may be that if you think that growth will slow down because you think that their situation in Argentina won't actually improve, then generally maybe this isn't a company to invest in. But in terms of me, I'm seeing how they've handled the Argentina position. They've actually done quite well with it. They've actually applied to it quite well in terms of the fintech space. So I think it will improve over time. And then we've got their Mexico and Brazil positions, which are growing steadily and in all areas. So I opened a position in them. But that's just me. It could be that my risk tolerance isn't the same as yours, and it may be that you don't really like this company. But let me know down below, and I'd love to discuss it with you guys. Thanks for watching though, I do appreciate it, and I'll catch you in the next one.